I want to start with the Australian dollar. It did weaken quite significantly after we had the Reserve Bank of Australia lift the cash rate again. I mean, normally you'd see a currency strengthen when there's tightening, but not in this case. Is this more a story about US dollar strength?
Principally, I think it's a story of US dollar strength, although I think we've seen across a lot of central bank activity in recent months, except the Fed, that whatever any other central bank does, even if they exceed expectations, any support that comes for the currency seems to be rather fleeting. I think the other thing, certainly our read of the RBA and some of the wording in the post-meeting statement hints that we could be coming to the end of 50 basis point incremental rate rises. So NAB's economist view is that from here we're looking at that 25 being more likely than 50 at the next couple of meetings. So to some extent, I think, and also the RBA was still stressing the desire to try and keep the economy on an even keel while dealing with the inflation problem, which is a little bit of a contrast to the likes of the Fed and the RBNZ and, dare I say, the Bank of Canada, who are all sort of hell-bent on inflation is going to come down to target at all costs. So maybe a hint that the RBA hasn't got quite that hawkish disposition. So I think the combination of that, but primarily onwards and upwards for the US dollar, new 20-plus year highs on various indices last night. So I think that's first and foremost the story. Yeah,
does this mean we're going to see continued weakness for not just the Aussie but other currencies as well? Because the Fed, as you say, showing no signs of letting off the gas when it comes to tightening.
That's right. So it's either because the Fed's got a bigger job of work to do, and so the market's having to revise up its expectations of where the so-called terminal Fed funds rate will be. Treasury yields poking above 3.25% overnight, which just really tells us most of what we need to know about the weakness of the Japanese yen. But if markets are also, fretting about the downside economic risks inherent in more aggressive tightening from the Fed and other central banks, and we get those risk-off episodes, that also lends itself to safe haven support for the US dollar. So it's really a case of the US dollar can do no wrong for the time being.
Ray, I came back from holidays and the Japanese yen passed that 140 level, and I'm really amazed at the level that we're at right now. How sustainable is this? I mean, are Japanese authorities going to intervene in the markets, or are we going to see a tweak from the Bank of Japan? How does this really adjust itself?
Well, I think that the bottom line is that if the Japanese authorities aren't happy with dollar yen sustaining a move above 140, and I do think that probably the cons are starting to outweigh the pluses as far as the impact of yen weakness, and particularly what it's doing both to households and businesses in terms of import prices that are already sort of under the cosh, if you like, from higher energy prices. Something will have to be done. Our sense is that intervention is going to be an instrument that is going to have only momentary impact if it's not coordinated, if it's not working with the grain of monetary policy, which, to a large extent wouldn't be the case if it was coordinated with other central banks' tightening policy to then be intervening is sort of contradictory. Really, if the BOJ, if the MOF really wants to do something about it in coordination with the BOJ, the only option is to do something with its yield curve control policy. So heading into that September 22nd meeting, I think it is going to be a pivotal one. If we don't see any action there, say in form of a widening of the tolerance band around the 0% 10-year YCC target, and if Treasury yields are still trending north of 325, look as though they're, for the time being, moving into a 325 to 350 range, and you look at the charts, technically there really is very little technical resistance above this 140 level until you get to the previous highs around 147. So in the absence of BOJ action on the 22nd, I think high levels are almost baked in the cake.
Yeah, I mean, BOJ meetings have become super exciting in the last few months, but really a different take has been what's happening with the Chinese renminbi, right? I mean, we are seeing that trade surplus support coming for the Chinese yuan. This chart on the Bloomberg showing how we're seeing that trade surplus hitting records this year already. Where is the PBOC in here? Because we are seeing them also keeping the yuan fixing stronger than expected for a few sessions already. How comfortable are they?
It's hard to know how comfortable they are. What we've seen, obviously, we saw that reduction in the FX reserve requirement ratio announced earlier in the week. That doesn't seem to have had any impact, even though ostensibly it frees up more foreign exchange that could be sold to support the yuan. We've had, 6 or 7 consecutive days of protests in the form of dollar-yuan fixing rates that have been below market implied levels, all to no avail. And yet we've got the dollar CNH. I think it hit above 697 overnight, so new sort of cycle highs there. So if the PBOC is really determined to stop a breach of that 7 level, it's going to be much more heavy-handed. But the fact that we've seen all of these various actions and dollar CNH is continuing to trend higher, it almost tells you that maybe the Chinese currency is a market-driven exchange rate to a large extent, which is not something I think I've ever uttered on a previous appearance here. So, clearly they're trying to check the rise, but in the face of unrelenting US dollar strength, you'd have to say that, a test of that 7 level looks highly probable.
Yeah, I mean, currency pairs have become so exciting lately, and I really love having you on, Ray, because we can go through the array of pairs right now, and I want to go to sterling because, of course, we've had the latest changes in the political scene there. We are getting the readouts from the White House when it comes to President Biden actually having a conversation with Liz Truss for the first time, saying that they discussed China, Iran, energy. So many different factors really being felt in sterling right now. What's the driving force there?
Well, I think about sterling. It's been a big underperforming currency in recent weeks, and a lot of that has to do with effectively expectations for the size of the economic hole that the UK is destined to fall into on the back of those astronomical rises in energy prices coming down the pipe, together with tax increases both on businesses and consumers. It now looks as if incoming PM Liz Truss gets her way, then they could be sort of vanished overnight. She's pledging to repeal those tax increases. She's pledging to use a huge amount of fiscal support to actually cap household energy prices. To the extent that that means that the economic outlook may be less bleak than otherwise, it does justify an unwinding of some of the shorting of sterling that we've seen. Although, looking further ahead, throwing the sort of almost 10% of GDP at the economy in ways that won't enhance the underlying productivity or growth rate of the economy is arguably questionable as a positive force for sterling. But I think in the short term, we need to see details fleshed out as exactly what's proposed, how it's going to be funded. But for the time being, we're less negative on sterling than we were previously. Yeah,
energy prices are not unique to the UK. Really, the whole of Europe suffering with this issue. We've just had the euro fall now through 101. Where's the floor for the euro?
Well, we've been saying for a while now that we thought that levels on euro dollar down to as low as 95 are certainly possible. Given the recession that does confront large parts of the eurozone on the back of energy prices. Obviously, we've heard from the EU Commissioner with proposals to similarly try and provide a degree of support for households through potentially a windfall profits tax on on electricity suppliers. So again, if that comes to fruition, maybe the Eurozone economic outlook is not quite so bleak, but yet again, you compare it to the US, look at the strength that we're still seeing in the numbers, and the US still looks like the least ugly duckling. And for the time being, we haven't seen anything to change our view that Euro-dollar is destined to spend more time below parity.